I'm curious, does delta have a range for you? Like you would never go to 90 or you'd never go to 60 or something like that?
Not at all. I really don't care what the delta is. Honestly, I don't care what the delta is. All I'm looking for is liquidity and pricing. We talked yesterday. Oh, Mike, your face is covered right there. Everybody wants to see your beautiful face, so we're going to do it this way right now because I want to keep the chat rolling. That helps me as we're going. I care so much more about liquidity. And then, you know, there's going to be stocks with less options available. Like if we go to like like AT&T, it's going to have less choices than something like than Tesla or SPY or whatever, just because it's not as exciting of a stock, right? So if we go to here, the delta, it goes from like 66, 82, 91, 100, right? It doesn't have that many places to go, right? It doesn't even have a 50 delta. 50 delta is always at the money. Like you've got a 50-50 chance basically. But yeah, you could go to the 60. You could go down to the 60, you could go up to the 90, and you're going to get approximately the same outcome. It's just when I'm pricing them out, that 80 delta is always in the wheelhouse. Always in the wheelhouse. Now, there's a couple other things to keep in mind too, right? The further up you go, the more expensive they get. So if you're buying one at the 80, if you're choosing between the 90, the 80, and the 70, the risk to return, well, maybe not risk to return, but the leverage that you get actually diminishes at one point. There's a diminishing point of return, or point of diminishing returns, where you're paying so much more, but you're not getting that much more in the option. So let's look at this one here, right? So this is 100 delta, basically everything above 2650. And if we look here at 27, it's 91, 2750 is $1, right? So you can get pretty much the same outcome, and it costs you $8 or $1.45, right? There's definitely a point of diminishing returns. And I found that greater than 80, you start reaching that point, right? The options become so much more expensive without yielding that much more of a delta for you. So let's break it down. Let's break it down math-wise.
And the problem with an expensive contract is you can buy fewer of them.
Exactly. Yeah. Or you can buy the correct amount based on your risk size, but then it keeps you from buying more of something else.
Right. And then doesn't it take longer in order for you to catch up? When the price moves, you're still catching up to your break-even point, right?
Only extrinsic value does that. I hear what you're saying. It's the current price plus what you paid for the option contract, but that's only the extrinsic value for you to catch up. I know exactly what you're saying there, Brad. You're totally right on the money, but you actually pay less in extrinsic value the further up you go.
Right.
Yeah. So let's do this exercise here. Let's do the 25, 26, 27, 28. So the price, let's do both extrinsic, intrinsic, and then the price of the option, not price. There we go. EXT. So look at this. I told you guys we're going to make some great content out of this, right? Super easy to do because I love this game. This is my jam. This is like talking basketball with Michael Jordan, right? I could do this all day, every day in my sleep, upside down, backwards, with both hands tied behind my back and blindfolded because I love it so much. All right. So extrinsic on the 25 is 4 cents. Intrinsic is $3.34. So our price, which is the sum of those two, but not the 25, equals this plus this, right? $3.38 on the 25 contract. We're right in between those 2 points. We can all agree with this, right? Everybody understand? If you understand in the chat, type the number 25 in the chat because you guys are learning too. If you understand how the price of the option is calculated, type the number 25 in the chat. It's the extrinsic value, which is our uncertainty, which is definitely something we're going to do from now on. The uncertainty value plus the moneyness value. How would you even spell moneyness? M-O-N-E-Y-ness? M-I-S? How do you spell moneyness?
With a Y.
I don't think it's a word. It's not a word. You can spell it any way you want.
It's a word to me.
It's a Scrooge McDuck word.
I was actually about to make a
now
reference. Yes. Moneyness.
You, I like that.
Okay. So we got the extrinsic value, the intrinsic value, and the price. This is how we get to there, which is why it basically is the midpoint between these two. Now let's do the 26. And actually, I need one more thing. Let me add delta. Insert. Now, for those of you,
sorry.
Oh, I was just going to say, for those of you who don't understand what delta means, delta is, in fact, we could definitely use that in this equation. Delta is the rate of change and how much the option is going to be worth for every $1 change in the underlying stock. So, example of the 25 delta at 96.43 means that every dollar that AT&T goes up, this option is going to go up by 96 cents. Okay. Now let's do the 26. And Mike, were you saying something?
Yeah, I put a little, like if you have Robinhood or Webbull, they don't have the extrinsic and intrinsic. I put a little calculator out there in the Discord, a sheet like this that calculates that for you, which was great for me because I haven't moved my money yet because Robinhood makes it easy to earn 4 points. But so if you're in something where they don't have that, and maybe it's not that hard, but I thought it was kind of cool.
No, that is cool. I'm noticing an issue here with liquidity. Like the delta at the 26 is a higher delta than one here. Let's look for a different stock real quick that has more liquidity. We really need it for this exercise here. So let's go like to IWM, the small cap ETF. You can pick any stock. It's going to get you there. It's going to get you the same outcome. But let's do it this way. Instead of the 25, let's go with the 195. Let's go with the 205. The 210 and the 215. Okay, so let's do this again. So the delta on the 195s is 97.92. The extrinsic value is 12 cents. And the intrinsic value is 18.63. Gives us a price of 18.75, which is between those 2 points. The 205 has a delta of 91.18. A extrinsic of 32 cents and an intrinsic of 8.63. Now, for those of you who are asking, there's nothing wrong with AT&T, but it's because of outside of market hours. It's not as up to date as it would be. In fact, I wouldn't even look at anything the first 30 minutes of trading. Stuff moves all over the place at the opening, which is another reason why I don't trade the opening, right? The volatility at opening is bonkers, and it really means nothing in the grand scheme of things by the end of the day. So 72 delta on the 210 with a $1.20 of extrinsic, and then 363 in intrinsic. Hey, do you guys notice anything yet? Do you see a pattern? I'm just curious.
Extrinsic equals the price.
What was that?
The extrinsic and intrinsic added together equals the price.
That's true. Not the pattern I'm looking for, but that is true.
No.
The price decreases the closer you get to the current stock price.
That's a good observation. Anybody else?
The delta decreases.
What I was actually looking for is, and you guys are correct, but it wasn't what I was looking for, but that's okay. Did you notice how each one of these is 63 cents? Right?
No.
Yeah. Why would it be 63 cents? How do we get to the intrinsic value? Let's answer that question. How do we get to intrinsic value? Which is the moneyness. You tell me.
Price minus extrinsic. You're welcome.
Nah. Good try. The intrinsic value, the moneyness of it, is the current price. So let's write current price. The current price of IWM is $213.63 after hours on pre-market Thursday, June 12, 2025. How do we calculate extrinsic? It is the value of the current price minus your strike price. Watch this. This is going to be math. It's going to blow your mind. This minus this.
I'm trying to find my calculator. I lost it. It shows that, but I couldn't find it. But it's in the Discord.
213 minus 205. What would you guess that would be? If you said 863, the price is right.
You'd be right.
This is the moneyness. This is what we care about. This is the goal with every option that you buy, is to increase in intrinsic value. Okay, so let's do the exercise again. Current price minus strike price. 363. Same thing. Same thing. Oh, wait a minute. Something ain't right here. What's this? Right? Current price minus out of the money option. I totally botched that. Hold tight. Out of the money option. Negative $1.37. Interesting. So the price of the stock has to move $1.37 to get any intrinsic value. This is an out of the money YOLO call. Right? Remember, YOLO calls. Look at how much we're learning today, just hanging out. Isn't this great? Out of the money YOLO calls are 100% extrinsic value, and they will decline in price until nothing. Leveraged investments are the in the money calls. The deeper in the money, the better you get, because you're spending less and less for the extrinsic value. So looking at this, we have extrinsic value of 12 cents, 32 cents, $1.20, and $1.91. In fact, let's put a little chart on here. This will be interesting. Insert chart that. Look at this. Right. The extrinsic value increasing the further down we go, where the intrinsic value is decreasing the further down we go. Does everybody see that? Extrinsic is, in fact, hang on. Let me redo that chart. Let me redo that chart so I can put the titles on there. Insert chart, go. Okay, so the delta decreasing. The scale of this is not working like I want. Hold tight. Let's move this to the right-hand side.
You could run your percentages off that table too.
Secondary axis. There we go. There we go. Okay, so check it out. The further we go into, or I'm sorry, the further we go out of the money, right? So we're deep in the money here at the 97 delta. At the 97 delta, we're basically at 100 on the delta. We have about 20 in intrinsic value, and we have about 12 cents of extrinsic value. But the further we go down the options chain to the money, the closer we get to the money, you'll see the extrinsic value starts to increase rapidly, where the delta starts to decrease rapidly, right? So this is what I'm talking about, the point of diminishing returns. At some point on here, the intrinsic value basically starts going 1-for-1 with the market, 1-for-1 with the market, and the extrinsic value doesn't move enough to justify that change in price. So to me, that really hits around the 80 delta. And in fact, let's see. I wonder if there's like a spot on the chart where it kind of makes sense. I think probably here at this inflection point would make a lot of sense, right? Because you can see the extrinsic value increasing so much from the 91 to the 72. In fact, let's add one in between these two. Let's add the 80 delta. I'm actually really curious. Oh man. Let's add the 80 delta. The 80 delta is the 208 strike. That's 80.82. The extrinsic value is 0.77, 0.77. The intrinsic value is 4.63. The price, then we'll do the math here again. This minus this, 563. Did I do something wrong? I may have looked at the wrong strike. 563, yeah. Okay. As you can see, right, the more extrinsic value grows, the more your delta shrinks, right? So we want to find that inflection point, and maybe it's where they cross. Maybe it's where they cross. Maybe that's the optimal point where you're paying not too much for the option, yet you're getting most of this move. So let's see. Let's do some maths here. I like maths. Let's delete this. And what is the price difference between? This is just an exercise. I'm thinking out loud. Where can we find? or the best risk return would be as far as like delta. I don't know. This is going to take me too much time for a live stream. Y'all are going to get bored and leave. But Mike had a question earlier, and it revolved around exit points. So where I'm trying to go with this before we jump over to Mike's question is there is a point of diminishing returns. And I would put it probably somewhere between the 70 and 80 delta, that once you reach that point, you're paying too much for the change in dollar price for the amount of delta you're going to get. And that at that point, that's where it's like, okay, it doesn't really make sense to do that. Okay. I got it. Ready? So this is $10 apart, yet your delta is only 6 cents, right? Equals this minus this. I got it. Right. $10 difference. But your delta grows by how much? Equals this minus this. So you're paying $1,000 more per one lot to get 6 cents more on each option. Does that make sense? Right? This is $10 difference here, yet the delta, the amount that you're going to grow per $1 change in option, is only 6. So you're paying, let's round this up to times 100. Right, so you're paying $1,000 more per one lot, and you're getting $6 more in return. Okay, I don't think this is computing for you guys. So let me work on it.
$6. You're talking about a flat 6, or is that times 100?
No, that's your flat 6. Yeah, let's do it again here. This minus, I'm sorry, wrong one. Let's just copy down. Okay, now here, from the 90 to the 80 delta, it costs you $300 more per contract, yet you get 10 deltas more. Okay, do you see how this percent, let's do a percent, equals this divided by this. And then let's make that in percentage terms. Actually, this is a really cool exercise. I'm glad we stumbled on this. Right. The change between these two represents 0.67% in increased value between the two, right? Increased moneyness, basically, is only 6% on this $10 here, $10 between the two. Now, this is 3.45%. Now, let's carry that exercise down. This is the 72 delta. So look at how fast this falls off a cliff, right? If we added more, we could probably nail it down. And let's do this here. Right? Do you see how this, the additional reward that you're going to get for how much you're spending just goes off a note, goes down a cliff, right? In fact, let me add a few more strikes on here. This is a very interesting exercise to me. Everybody watching it's probably asleep by now, but this is
that's good. It's good.
I got my coffee.
You need a copy for this. Okay, 195 equals this.
I wish there was a way to export this content to Excel. That'd be great.
You wish there was a way to what?
Export from Tradier into Excel or Sheets.
Oh, yeah, that would be handy. That's okay. With my master keying skills, we'll get there really quick. All right, so this is actually going to be really interesting. Everybody, if you're not asleep already, type "I'm not asleep" in the chat. If you're not asleep already, I'm going to make sure you get there pretty quick. Okay, cool. Let's do this. So delta goes from the 195, 97.92. Okay, so I'm just going to type this in real quick. 97.52, 97.1, 96.65, 95.17, 95.8, 94, 92, 94.41, 93.84, 91.50. We got that one. 87.27, 86.9. Got that one. 80.82, 77.11, and 72, 62.69.
I'll tell you what, Chris, while you're doing this, I can answer Arnon's question.
Yeah, go for it. In fact, you guys answer questions in the chat. That would be super cool of you.
Yeah, Arnon asked if I trade options in Schwab. I do on paper. And if you don't know, paper trading is a way to prove out your trading plans, for instance, see if you're going to be successful with a trade, matches real world data. I don't trade live money in Schwab because that's not where I hold my funds, actually. And I don't hold it there because my active broker does have a settlement fund that gives you interest. And I don't have to worry about selling an investment in order to make an investment with my active broker. Otherwise, I only use Schwab for the options chain information because my broker does not have the options chain information. I can just trade my chosen contracts after I pick them in Thinkorswim.
In my options trading experience, I think I have 3 trades. Anyways, I just see what Chris is talking about, the voodoo of the leveraged investment part of it. You can get so much more on a win in an options table than buying shares. That's the draw for me. So yeah, as soon as we get a buy signal, we'll try to make some money. But yeah, I think the options just, man, for such little input, you can get such big gains. And if you got a plan, you can get out before, with small losses for sure.
Manny asked, where can I find the Outlier 9 template in Discord? You would look in the VIP Investors Toolkit. You do want to be careful. There is an archive VIP Investors Toolkit, which I found the other day. You just want to chase the VIP Investors Toolkit and look for, I believe it's the second link up for Chris's latest presentation.
Did it backwards. Almost done. Cool, we found it. Right there. The 9150. Well, maybe not. This is so interesting. Okay, so let's go through what Chris just wrote down. Chris just wrote down a whole bunch of numbers. Now, I've told y'all this before. When yes, that's the point of diminishing returns. When I first started trading options, I remember the very first day that I heard about trading puts, and I'm like, oh my gosh, I have to do this. And I pulled up an options chain, and it looked just like this, and I was like, what in the wide world of sports is this, right? I don't know what I remember vividly in my head thinking to myself, I have no idea what all these numbers mean. I just want to make money. So because of the study, the love of the game, the passion that I put into it, there was nothing that was going to stop me from making this happen. So if you want to be successful in the markets, you have to approach it from that level of determination, right? You'll never be successful in this game. This should not be treated as a hobby. This should be treated as you can create generational wealth because of this. So let's look at the numbers here. What we're trying to measure here is the change in strike price. And then Alt 30. Boom. You like that? In case you ever want to know what the symbol for delta is, it's Alt 30. And this is the change in delta. Alt 30. And this is the change in the this is the percent change between the two. So let's take a look at this, right? If I'm looking to put on an options trade, I generally go for the 80 delta. So let's just highlight that yellow as like our baseline here, which seems to be a pretty awesome baseline, by the way. Here, for every $1 change in the delta, right, for going from 214 to 215, that's a strike delta. Did I do that right? Yeah, because I did further on. Right, it's a $1 change in the strike delta. Okay. Now, that didn't work as well as I wanted. It's a $1 change in the strike delta. And the change in the actual delta is only 6. Okay. 6 here, 6 here, 5 here, 5 here, 3 here, 3 here. Some of these are not going to be as liquid, so they're going to have a little bit weird numbers here. But you can see overall that it's basically going down. The rate of change between A to B B to C, and C to D is called gamma. One thing you can see on here is the delta change actually is changing by a smaller amount each time. We're getting in a deep options theory right here, by the way. 656 between the 215 and the 214. That's the delta change. That's how much the option contract is worth to go from 214 to 215 for every $1 change in the underlying stock, okay? Then you can say you go up one, the change between the two deltas is 629. You go up one, it's 611. So we are actually accelerating the gamma change as we go, right? Because this is not a linear change between these 2 points here. And it's continuing down, continuing down, continuing down. Unfortunately, this is out of market hours, so it doesn't quite fit our narrative that we're trying to do here. But going from this, as it's moving down, you're going to see the point where it gets smaller and smaller and smaller percent change until it basically flattens to nothing, right? Now, like I say, out of market hours, so the numbers are going to be a little bit wonky, but it's 6% change, 5% change, 3% change, no change. So this is where I would say there is a point of diminishing returns and it just like flatlines, right? The change in option delta is not worth the additional price that you have to pay for that because the intrinsic is going to go up in a linear fashion. The extrinsic is going to be on what's called an asymptotic curve. Asymptotic curve. An asymptotic curve looks like this. We're going to plot it out in just a moment here, but I'll show you what an asymptotic curve is. It goes towards zero, but never actually hits zero. Because the extrinsic value does that, we want to make sure that we don't buy anything right here where it's not changing. It's not worth the change in value. Okay, so let's graph this. Now, like I say, the numbers are going to be a little wonky because of outside of market hours. If we did this a couple hours from now, it should be better, but I did it the opposite way. Well, no. It's doing it right. That's the asymptotic curve, but it's moving the other direction. Do we see this? It like freakishly heads towards zero and then flattens out. Right? We want to make sure that we aren't overpaying in this area down here, and we're not too far up here where we're paying too much of extrinsic value. So here is where we need to find the balance between the extrinsic and intrinsic. I wonder if we do a chart like this, if there's going to be like an X. There's got to be an X. Yeah.
And again, the reason you're trying to find that balance is that you can maximize the number of contracts you can get in this trade and also allow you to take future trades with other assets.
Exactly. So I was hoping that they would cross. Let's remove delta from this. Okay. It crosses at record 18. Where is that? Let's count this. So 0, record 18, around 60 actually is where it crosses. That doesn't necessarily mean that it's the best, but that's where it does cross, is around this 60 value right here. So I wouldn't go to the 60 because I don't think you're getting enough, but maybe the math is right and I'm wrong. Right? Maybe there's a point of the diminishing returns like Yusha's saying here. So really deep options theory that we're talking about here, but I'm trying to make sure that I pay as little extrinsic value, but not overpay in intrinsic value. And that's why I generally settle at the 80 delta. But I'm okay with going a little higher to maybe the 90 if I have to for liquidity's sake, or down to the 70 if I have to for liquidity's sake, as long as the extrinsic value doesn't overwhelm the total price of the option. So let's look at percentage on here. So if we do this divided by this is what Chris looks for, and I generally go for around 20%. All right, so in this case here, the 20% would be somewhere between the 209 and the 210, which put it right around 75% here. Which means if I went to the 208s, I'd actually feel like I was getting a great deal because I'm only paying 12% of extrinsic value versus 20%. So maybe in this case it's right. Maybe in this case the best spot is more closer to the 60 delta. So like I say, this is record 18. Between record 17 and 18, if we go down to here, that's between these 2 points here. Maybe for this particular stock, that's the most optimized option spot. Maybe, I don't know. It would be really interesting to see if we could plot this out in the future and kind of adjust based on that. But that puts you around 30-ish%, maybe 40-ish% on the extrinsic value, which is too much for me. So either way, super deep theory lesson that we just went through. I don't know if it helped anybody.
Well, now when you get closer to you're getting down close to the money line there and then getting out, what happens on those shorter windows then? I mean, isn't that going away faster or the closer you get? I don't know what I'm talking about. The closer you get to the lower left window of your options table, let me put it that way. Well, I mean, in your actual options chain.
We're here?
As you go down and then below the line, you're out of the money. So
correct.
Okay. So that's why I'm just wondering what the time, like when all right, let's go the other way. Say you're winning, that you're doing really good in this trade. When you jump out, I mean, you don't hold it till like you get out a week ahead before it expires. Do you get out a day ahead? I mean, I'm just wondering about you being so close to the out of the money. Is that going to come up quick?
You would go to your exit strategy criteria, right? And one of those happens to be
right.
If I'm a week out or something, and
it's a week out,
I can roll it up for a credit. I take the credit, but if I can't, then I'm simply going to get out. Like I always have to reference the.
No, you're correct. Yeah, if it's already profitable and you get to a week out, go ahead and close it. Now, a great question would be why? If I'm already profitable, why do I want to close it? Here's the thing, right? When we get closer to expiration, right? So this is going from a week out to less than a week. The uncertainty rises for me because I don't know if we're going to have a big move. And if we have a big move, my option, let's put, let's say $5 in the money, 603 here, and let's do $5 out of the money to 217 to 207. There we go. Let's say we're a week out and we have a $10 move, really a $5 move out of the money, right? Right now, that out of the money is worth 72 cents, which I would be super pissed to watch my investment go down to 72 cents. Mm-hmm. And then we go over here to the 217 and it's worth basically nothing. It's worth basically nothing. So your gamma risk, right? We talked about the change in value over time. The gamma risk explodes because the closer you get to expiration, if it goes out of the money, you basically are watching your investment just evaporate. We don't want that. We never want that, right? If you reach expiration, you're still holding on to an option and something goes haywire on that one day, your investment's gone. Your option is worth nothing. So the closer you get to expiration, the more you want to be rolling that thing out in the future so that if stuff goes wrong, you're not absolutely kneecapped with nothing to do. You have no way to save your investment. It's just out. It's just gone. It just evaporated. So that's why I go for 1 week to expiration to move it out. Now, can you roll it for a credit? That's the real question here. Can you roll it for a credit? When you roll it for a credit, you're basically going from, and it's not always possible, which is why I say if you can roll it for a credit. Let's say that I'm in the, let's go to the 90 delta, right? Let's say that I'm in the 206 right here and it's worth $6.01. And then I need to roll it out in the future for a week. Let's go to here to the 206 again. It's 667. So if I went from 206 to 206, I would have to pay an additional 60 cents. I don't want that. That adds risk for me. But if I roll it from the 206 to the 207,
man,
we might be able to pull in 19 cents, right? This is 578. This one was 591. So I might be able to pull in a little bit of credit, and that's all I'm looking for. I'm not looking to make giant uber profits on this. I'm just trying to hold the trade longer. But I do not want to pay extra to hold the trade longer. Does that make sense?
Yeah, and so the time frame, the window you choose for 21 days, 30, whatever, people do it different, but yeah, anywhere on the lower part of the upper left in the money. I guess that didn't. I was concerned that the closer it got to the out of the money section, closer to the line there,
Closer to the money.
Closer to the money was where it would. I thought maybe that was a shorter window. I mean, am I looking at that?
You're not wrong.
That has nothing
You're
to do
not
with
wrong at all.
Okay.
No, in fact, the closer it gets to the money, the more risk you have. And that's because if it falls over to be out of the money, your option's worthless, Mike. Your option is absolutely worthless.
Okay.
But if it's still in the money, you get the intrinsic value. So you are right. The closer it gets to the money, the riskier the trade becomes.
Okay.
The deeper it gets in the money, the more certainty you have, which is why we have less extrinsic value, right? And so we measure that here. Now, there's also, on the flip side of it, right? Let's make this bigger. The closer you get to the money, you can see the uncertainty rises, the extrinsic value rises, and it peaks at the money. And then it actually goes back down, right? So imagine it looks something like this. Right? Imagine this is a volume slider, and it's peak volume right here, and then it goes back down over here. Now, why would that be peak volume right here, and it's lower over here and lower over here? Tell me.
You really broke up. I've got lightning storms and you're flashing in and out, so I missed the question.
Yeah, all I hear is excuses, Mike. Okay. All I hear is excuses.
You just now came back. All I hear was you don't hear my excuses. What?
Sure. Yeah, I hear excuses. Okay, but I'm just playing with you, Mike. Let's look at this, right? So if we're looking to the extrinsic value, this is our uncertainty. Uncertainty. And the certain thing here is that I draw like a 9-year-old. Okay, that's our uncertainty value, is the extrinsic value. The deeper we go in the money, there is less uncertainty because it's in the money, right? It can stay there and we're still going to make money.
Yes.
The further out we go out of the money, there's less uncertainty because a lot has to happen for this to go in the money. A lot has to happen for this to go out of the money. However, the uncertainty peaks. The uncertainty peaks right here because we really don't know if this at the money strike is going to be in the money or out of the money. So that's why the closer we get to the money, the more the extrinsic rises, and the further we get out of the money, the extrinsic falls or deeper in the money. Does this make sense? Because we don't know if these strikes here are going to have any value at expiration. The extrinsic value is at the highest point right there because it has the greatest uncertainty. Everybody following?
Yep.
Cool.
I've heard you say that you don't want to buy a contract that's more than $10. You've kind of adjusted that a little bit.
Dude, if I hadn't adjusted that, I don't know if I would have been able to pay off my wife's student loans. That was such one of those like divine moments. Like, hey, that $10 limit that you had forever, it's $11.70. Just give it a shot. Yeah. So I'm like, okay, all right, that makes sense.
So do you did not eat my homework? I saw that.
Right. Sure, Mike. Sure, Mike.
Do you put any consideration into, let's call it the average of the bid-ask spread? So likely the price you're going to get it for versus the price of the stock. Meaning if it's a really expensive contract compared to the price of the stock, maybe that's not a good entry. Is that a criteria?
I don't know. The way that I look at it is you can get basically a 90% discount on the stocks that you're buying. Let me go through what I mean by that. So we're looking at this. Let's go to the 80 delta. The cost of the option. Hang on, let me actually zoom out slightly over to 21 days to expiration here, July 3rd. And then go to the 80 delta right around here. Okay. So for the 202 strike, current price is $211. I could pay, basically, if you think about it, $11 per share to own a stock that costs $212. This is where things break. This is where options become the most obvious thing of all time. Imagine.
I love that.
Yeah, Mike, imagine.
You're buying the right to control it, right?
Correct.
Like, because you could choose to purchase at 202.
Or not. Yeah. So imagine I am making a deal and I'm like, Mike, what if I made you a deal where you could buy a $200 stock for $11? You take that all day, wouldn't you?
It's awesome.
Right? Yeah, all day. But, I'm going to make sure that I get a little cut out of it. That's my extrinsic value. A $200 stock you can buy for just $11 per share. Go nuts on it. That is the efficiency of options. When you understand how to use that leverage, this is what Larry Hite taught me. If you can understand how to use that leverage, you can make gobs of money. And here's what's cool too about options. We talked about how the delta rises as it goes deeper in the money, falls as it comes further out of the money. Your option helps you and gets more valuable the deeper in it goes. But if it works and goes the opposite direction, your delta decreases, meaning you lose less. Right? So consider this. For every $1 change in the stock, the further up it goes, you earn more dollars per underlying. For every $1 move in the stock, you earn more dollars. If it goes down, you lose less dollars for every $1 that it moves against you. Right? So let's do the exercise on here. This is so much fun. I hope you guys aren't asleep yet because I'm loving this. Looking at this one right here, I don't know if that highlight's going to come through very well.
It does.
Okay. Looking at the 202. Let's say it goes from 211 up to 220. Let's make that easier. 222. From 212 to 222. Or goes down from 212 to 202. Our delta increases, right? So let's say we bought this one. Now, let's say it goes $10 deeper. I didn't capture that one, but we'll use the 193. Our delta rose to 94, meaning for every $1 move, we aren't making 81 cents anymore. We're actually making 94 cents. That's pretty sweet. We like that. Now imagine it goes $10 the other way, from 202 up to 212. Now, we're not losing 81 cents for every $1 move in the underlying stock. We're actually losing only 50 cents. This is a game changer once you understand this, right? Not only do you get incredible leverage here, but the leverage works for you as you're winning and for you if you're losing. It's such a game changer.
It's awesome.
Unbelievable game changer here.
That's exciting stuff, man. I love that kind of stuff.
Yeah.
Yeah.
And as Albertone says, I can't believe we're getting all this value on YouTube with a full money back guarantee.
What if I wanted access to Outlier, Chris? What would that cost me?
That's a good question. Right?
Is that expensive?
Right now, we're running a special. I don't know if you guys heard. We actually will allow you to get access to the annual pass. If I can find the slide. Hang on. There it is. We can give you access to the annual pass for just 82 cents a day, which is an unbelievable value. That gets you into the software, plus everything that you see here, plus the Discord, plus everything to make your life so much easier, giving you literally everything you could need to be successful in the stock market. The real question is, are you going to be one of the people who listens, who takes action, and makes this happen and changes generational wealth for you and your family? Or are you going to be like everybody else? That's the real question here. I mean, legitimately, we're giving everything to you you could possibly need to be successful, and it's 82 cents a day. 82 cents a day. And in fact, it does include a free university course where I teach everything about options, about stocks, about how to trade, about how to manage risk, about how to let your winners run out of control and cut your losers short for free. It's included. How does that sound? That sounds like a pretty good deal, I would say.
Fantastic.
Now, we probably won't get into this deep of options theory in the university, mainly because I want to make sure that it's accessible to everyone. However, we are doing options deep dives every Wednesday, and I think that this is one of those areas where we can go into that. I did see somebody who ran some ChatGPT analysis on this. Patrick, ChatGPT says your 208 strike, only 6% of extrinsic value. After that, you're paying 16% for time decay. Clear efficiency winner, according to GenSpark. I don't know what the heck a GenSpark is, but let's go look over here. He said it was the 208, which is my 80 delta, which is where I've lived for years. Oh, wait, sorry, I'm not screen sharing. That's a 208 right here, which is my 80 deltas, which is where I've lived for years. So according to ChatGPT, I know what I'm doing. It's almost like I know what I'm talking about. All right, listen, Brian, give me a break. You can pay for hundreds of years with a single trade if you do this correctly. Yeah. And Jim, yeah, you can get a free 2-week trial. And if you're on the monthly plan, you can upgrade to the annual pass with just one click and save 64% off the regular monthly price. Guys, listen, I really appreciate the fact that y'all were available to come and hang.
Nice.
I hope this was worth your time. I know we got really deep in the options series. We kind of worked through some stuff together. But do you feel like you learned anything?
Oh, yeah.
Yeah, absolutely.
Mhm.
Cool.
Yeah.
Yeah, you might want to throw this one into your Wednesday trading playlist.
Yeah, this had a lot of meat on the bone. This is good.
Yeah.
I think I will do that. Thanks a lot,
Yeah.
Joe, with your great ideas.
Yeah.
Thank you, Mike. I don't want to hear any excuses later today, my friend.
Man, I got a big dog. I have a big dog.
I didn't give y'all any homework last week, so
Right.
you got lucky. You got lucky. Well, there's going to be a lot of homework for this week. I'm just telling you right
Can
now.
you not hear the thunder? It is storming here, man. And then between that and the flashing screen, I'm getting every other word.
I don't know what's going on with the flashing screen. Hopefully it's resolved. Maybe I need to restart my PC or something before this afternoon. Maybe that'll fix it. You guys are awesome. Can't wait to see you for this afternoon's Outlier University. We'll talk soon.
Thanks.
Yeah.
Thanks,
Yeah.
guys.